Alright, it's time to clear up some confusion around one of the most hyped events in investing, the IPO. Today we break down the IPO process from private funding to the first public trade. We'll also share who really makes money on an IPO and why most retail traders don't. Let's dive in. Every year companies go public through an initial public offering, or IPO. The idea is simple. A private company sells shares of itself to the public for the first time. This raises capital for the company and allows new public investors like you and me to buy shares. But there's a lot more to an IPO than meets the eye. There are dozens of steps and players involved. And today we're going to show you what they all are and how they all fit together. It all starts with private funding. Early-stage investors like venture capitalists put their own money into a promising startup in exchange for shares of the company. After some time, the company may be ready to go public. To do this, they'll need underwriters. Underwriters are investment banks like Goldman Sachs or Morgan Stanley. They help businesses follow the lengthy regulations to go public. But underwriters are only motivated by profit. They don't do this work out of the kindness of their hearts. Underwriters make money through something called underwriting fees. It's a percentage of all the shares that they sell in the IPO, so the bigger the IPO, the bigger the payday for the underwriters. But it's not just about making the IPO happen. Investment banks also want to make money on the trade itself. If they can buy low and sell high, they pocket the difference. So which shares get sold and at what price will determine how much money all the parties involved make or lose. Step 2 is the roadshow. During this time, executives and the underwriters travel around the country meeting with potential investors and building interest for the upcoming IPO. While this is happening, institutional investors and hedge funds can let the underwriters know how many shares they want and at what price they'd be willing to buy. This is important because once pricing is set, it's unlikely to change. So getting buy-ins before pricing helps signal strong demand. Pricing is step 3. Now that the roadshow is over, the underwriters have a sense of how much demand there is for the IPO and at what prices. Based on this info, they'll set a final price range where they believe buyers are willing to purchase the stock. This is done carefully, typically starting low, and then raising the price range based on demand. Even then, they might leave some shares unsold if they believe the current price range is too high. That's because they still want to ensure that there is enough buying pressure at the current price to prevent a drop when the stock opens for trading. Remember, these investment banks want to look good. They want to be known as the ones who accurately priced and allocated the hot new IPO, and while they're not doing this pro bono, they're also not trying to screw themselves over either. So it's in their best interest to accurately gauge demand and price accordingly. But while all this is happening, another group of investors are demanding a piece of the pie. So far, only accredited investors have been involved. These are wealthy individuals or institutions that have access to the best deals and the highest returns. But now retail investors like you and me are stepping in. When retail investors enter the market, it signals that there's a larger pool of people who are interested in the stock. If there's enough demand, the underwriters will raise the price range even higher and sell more shares. If not, the price range could go down. But what happens if demand is so high that more shares need to be added to the IPO? This is called the green shoe option. Underwriters can exercise the green shoe option to offer more shares to retail investors than initially planned. Exercising the green shoe option means more money for the company and more shares for the public, but it also means that the individual shares will be slightly less valuable. That's because the company is diluting its ownership pie by adding more shares to the mix. Finally, we reach the open trade on an exchange. On the first day of trading, the shares become available to everyone. If the shares are in high demand, the stock price may pop above the initial public offering price. But if there isn't enough buying pressure, the stock price may dip below the offering price. In either case, once the bell rings, it's too late to get in on the action. All the major players have already made their moves. Who actually profits first from an IPO? VCs, founders, and early investors cash out first. Most retail traders get in post-pop. Let's take a closer look at who those major players are. First, we've got the founders and insiders. They're the people who started the company and run it on a daily basis. They usually own a percentage of the company's equity and when the company goes public, they can sell some of their shares to make a profit. But this doesn't mean they're selling their entire stake in the company. They're still motivated to grow the company long term. In fact, many of them will hold on to their remaining shares after the IPO. Next, we have venture capitalists or VCs. VCs invest in startups in exchange for equity. They see potential in the company and are willing to take on the risk of investing before the company goes public. If the company is successful and goes public, VCs can sell some of their shares and make a return on their investment. Finally, we have the underwriters. Investment banks that underwrite the IPO. They're responsible for facilitating the entire process of taking a company public. In addition to earning underwriting fees, they can also profit by buying shares at the IPO price and then reselling them to investors at a higher price. Now, what about retail investors? Well, retail investors can't get in until the stock is publicly traded. They can't participate in the IPO process beforehand. This means that they're buying in after the IPO price is set and the major players have already made their moves. So who profits most from an IPO? While there are opportunities for retail investors, it's generally the VCs, founders and early investors who profit the most from an IPO. Retail investors are often left with whatever shares are left over after the big players have had their chance to buy in. But why don't retail investors get in on the deal? Wouldn't it make sense to let the general public buy in at the same price as VCs? Well, not exactly. You see, the VCs are taking a big risk by investing in a startup. They're putting their money in long before the company has proven itself. And there's no guarantee that the company will be successful. In fact, many startups fail before they ever make it to the IPO stage. By giving VCs the opportunity to buy in early, we're rewarding them for taking that risk. If the IPO is successful, they'll make a return on their investment. But if the IPO fails, they can cut their losses and move on to the next investment. But what about retail investors? Well, by the time they're able to buy in, the VCs have already had their chance. So what does that mean for retail investors? Should they jump in as soon as the stock is available? Or would it be smarter to wait until the stock settles down? Here's the thing. When a company goes public, there's a lot of excitement. It's a hot new stock that everyone is talking about. But that excitement doesn't always translate into a good investment. Sometimes the hype is overblown and the stock price pops way up, only to come crashing down later. So should you chase after a stock just because everyone else is? Not necessarily. As a retail investor, you have access to the same information as everyone else. So if you do your research and believe that the stock is undervalued, then it might be worth buying. But if you're just jumping in because everyone else is, you're relying on the hype, and that's not always a winning strategy. So when it comes to IPOs, it's important to stay level-headed. Don't chase after the latest hype. Do your research and make sure you're comfortable with the stock price before you buy. And that's a wrap on IPOs. We hope you learned a thing or two and feel ready to tackle your next investment. Thanks for watching.